currently. Okay, recording has started. That's good news. All right. And there was something. Oh, I want to ask this too. Um, so I added a little video to the confirmation email that should go to you when you register for the demo. But I have no way of validating if that worked. And it wasn't a perfect video. I shot it with Camtasia in the conference room, and I thought it would be helpful because it covers basics, so that we don't have to, that if you have a reference tool to go to that say, well, how do I use the platform? I can hit some high points for you, but that covers some very good basics for you. And tell me, did you see it? Was it in there? You saw? Okay, thank you, Robbie. I appreciate that. Okay, good. It's about 5 minutes, a little longer than I would have preferred. Okay, good. Martin, I'm glad to hear that. I did not have a blast with Allstate. I'll talk about that in a little bit. I'm glad that you did with WBD. Okay, so I've got basically 5 things. That's usually what I've got time to cover. On the basics, I just want to do this. Let me let Bob in, and then Brian, I'll let you do that. Let me share my screen. Screen. Getting a little bit of feedback too, aren't we? You guys hearing that? Dan, yeah, it might be you, Daniel. I don't know. Okay, that's better. Okay. I didn't look. The shop in the momentum portfolio, I didn't even look. You guys are venturing abroad. Okay, well, if you can freelance your way to better returns, all the better. That's good. Okay, so the only thing I will cover in the basics today, just because maybe it hasn't come up in a long time and it might be worthwhile, is this thing called the profiler. This was and it remains for the time being. It's our original back testing engine, and of course this was created right at the time that we launched the whole platform, and they're certainly imperfect. It's a very blunt instrument. The only thing that I really use it for, now, we're working on another version. When we're happy with it, that is much better at helping you see over a given period of time what your returns might be. We will put it up. We already have very good math on entries. I say if you get the entries right, the exits will take care of themselves. In most cases, if you're after a percentage, not a price, I'll explain. That's a core part of today. But what I use Profiler for principally now is, it's interesting to go back and look at, well, what's the top stock of in the S&P 500 year to date? Well, it's NVIDIA, up 200%, and so it's interesting to go look and see, well, why is that? Well, look at it. Spent 35 days at 5 and 85 days above 5. It just points out that the more time that stocks have excess demand, the better they're likely to do, all other things being equal. This isn't taking into account the supply side. And if you're brand new, when I say demand, that's a 10-point algorithm. That's what you see here. That's NVIDIA's sentiment, but that's demand. It's an algorithm that meters buying and selling under the rules of regulation national market system, a bunch of rules that govern how trades must be handled and routed and executed. And that is the core to the technology that Edge uses. So that's a 10-point scale. Above 5 tends to be better. Not always the case, but there's some pretty good evidence there. And then supply is short volume, the data set associated with the modified uptick rule. And that it's supply chain of the market. You look at Meta, whoops, let's go do this. I'll go back there. If you profile that, I'm going to expand this back again. It's just helpful to see. It reinforces that this idea of demand is a pretty good one. Now, if you're trading 5-5, it doesn't work in stocks that have a lot of momentum because you're going to miss out on where a lot of the gains occur. But once again, look at how much time does it spend above 5? 100 days above 5, 18 at 5. Only only 13 below 5. Just just interesting to know that excess demand produces returns. Okay, that is really it on the basics. So now let's get into the nuts and bolts. I'm going to come back and see if I can do anything about this feedback that we're getting. I think it might be here. I'm going to just, yes, I can. Where did I do that? Bear with me. Bear with me. I can't seem to mute that. Oh, did that help? Did we get there?
That's better, Tim.
Okay, good. All right, good. And let me take a look at the chat here. Okay, let me go back. Martin will look at WBD. Pamela, Shopify. We'll take a look at that. Oh, good, Gary. Gary Morris, the country music star. You read The Man Who Solved the Market. Very interesting. I mean, we don't come away knowing precisely what Renaissance Technologies is doing, but they're mathematicians. That's. I'm glad you read the book. I thought it was well written. Greg's a good writer. Does the volatility calculation apply to a daily move from start of day to end of day, or movement during the day? The stock moves up 1% in the morning, down 1% at noon, and back 1% at end of day. Is that a 1% move or a 3% volatility calculation? That's a very good question. It would be, what we're taking is the average rolling 5-day read of a stock's highest and lowest intraday price. That's really it. So that would be 1%. But it's interesting, you could add up that volatility, and we do that in certain applications for public companies to just point out how much volatility there is in the market. If you're running an equity cost of capital calculation using beta, it doesn't give you a good read, because beta is the return of the market. But if you put in volatility, you realize just how woefully expensive public equity capital is in the market today. Liquidity is very thin, and there's a lot of volatility. That's what we're trying to capture. That the whole basis of Edge is that if there are supply-demand imbalances that favor us, and we understand the volatility, then we have an opportunity to make a gain. But Steve, that's a good question. That's how it's calculated. But SHOT, for example, what's the meaning behind market sentiment declining but price rising, all while supply is also falling? We'll take a look at it. I mean, there are outliers at times, right? And I absolutely think that the data is being affected by this rebalance that's coming. I will talk about that in context, this big tech rebalance that could be. Well, I'll say, but I'll come back to that. So I will try not to forget that question. And Brian, if you'd help me, if I do, we'll make sure to address it. Okay. What is your status is set to do? Okay. Yeah, that's fine. Okay. Let's go back to the Rosetta Stone. Again, I qualify. When I say Rosetta Stone, I mean, I think that this is an excellent methodology. There were things, what we always understood is that supply and demand were good principles in the market, and you can always see it with broad sentiment. If we expand out year to date, and I'll do this again, I just show that there's a very high correlation between rising demand and rising prices, and topped demand and prices stop rising and falling demand, particularly when there's rising supply. If the market has very strong demand and insufficient supply, then prices rise. When supply begins to rise and demand weakens, prices tend to fall. It's not perfect, but the beautiful thing about it is, the problem with moving averages is that they're always backward looking. They're always a lagging indicator because they depend on history, whereas supply and demand are telling us what's coming. It's not perfect, but it's a very good principle. So using it, I said we would spend some time here, and I thought I'd just show you could do this however you want. By no means do you have to do this the way that I do. There might be a much more scientific approach to it than what I'll do here. But just for instance, this is what I kind of do at the beginning somewhere. I'm always careful. If I would prefer to buy a position today that is down, because I'll have a good chance. I'll have a better chance at the open Great, I bought Google. I bought Lamb Weston, and they were down most of their volatility. And then yesterday they immediately filled at the open up very nicely. That is the principle in action. And I think one of the things that helps make it work well is that all the rest of the market tends to be focused on the stuff that is rising pre-market. Well, they're the pre-market movers. What's causing this stock to be way up? And then everybody chases that, and they don't understand that the pre-market does not have the same rules as the NMS market does between 9:30 and 4. And machines are going to behave differently outside market hours than they do in market hours. And they're also going to know what the supply demand balance is in the NMS market because they buy all the retail order flow. They're the there are prime brokers in there who are going to know. They're going to have order flow stacked in. There are passives that will want, they may want a market or limit on open, or particularly at the close, market or limit on close, because they want reference prices. So one has to begin with a recognition of how the market works. So that doesn't necessarily work, and we're doing the opposite if possible. And look, I'd like to find a way to have more opportunities because only a handful of, let's say, these low volatility stocks, which are terrific, are down at the open. Let me see if I can pull up. Let's see. Let's just go here. And so what I do, kind of screwed that up, but I think this will still work. Okay, there we go. I might just go down this list in the morning because I really don't care which one it is. Unless KDP, which could be reporting results. Point number 3, context. Now is the time we have to be very careful and very aware of what's occurring. Always check the calendar. So I might, I just start at the top. I look at KDP. If it's down, here's its volatility, 1.1%. So if it's down 1%, might buy that, right? I'm serious about how it's, for me, I don't have that much time. It's not more complicated, and it produces very good returns. Not every time. I will give you some examples here where I got stopped out. Another great example. I mean, if the closing price the preceding day, 54.79, and then it drops, if it drops to 54, well, maybe that's not enough of Rexar, but it's pretty close. I mean, is that half its volatility? Pretty close to it. So might I buy that? And I wouldn't even look any further. And that's kind of what I do. I just go down the list until I find things, and and I hit Google. I think they're still in here. Lamb Weston is down here somewhere. I thought they were. Maybe they're out now. But there it is. Yeah, that is my methodology. You may have a much more nuanced methodology. What I am accepting in this process is that volatility is what the machines will give us. Machines are going to calculate, well, how willing are we to set prices? And those machines will know that limit orders are in the pipeline, and they will have a pretty good idea of the supply and demand balance in those. Well, how willing am I to move the price? I actually had to adjust my price on Cisco by 3 pennies. I calculated right today, this is how much I want in this position in Cisco, because it's down, it's in here too. Cisco was down all of its volatility. What's the probability I could make 1.5%? I just calculated that off of my entry point, 50.62. What's 1.5% up from that? And I put my limit in, 51.56. And the market went right to 51.51. 51.51 would not go any higher. I don't know. Maybe it's the same thing. Machines are calculating the same thing I am. Now, it should give me more than that. Probably will before the day's out. So I moved my limit from 51.56 to 51.53. It had a fair amount of it. And 5 minutes later, boom, it filled. I gave up $30 or something like that. I don't know what the math was. It wasn't much. And so now I will wash, rinse, and repeat. Can I find another opportunity before the close? And we'll talk about that, because there's this very important context that I think we need to be thinking about. But it's such a low stress way to go about it. Yes, there's the risk of being stopped out. This happened to me, and this is all part of this Rosetta Stone. I look for how much volatility is there. Are they down half or more of it? Then whatever my entry price is, I'm going to calculate, in low volatility, 1 to 1.5% in all probability. In momentum, maybe you can get a little more, 2.5 to 3%. Greater risk, more return. It's a very basic economic principles that work in the data all the time. And if you're happy with that and you keep repeating, it's remarkable. In 2 days, I went from, I went $2,000 up in my trading account, which is, about 50,000. And I did it 1% at a time, just taking 1%, 1%, do it again. And I find it to be, I credit this audience for helping to shape a way to make that very effective. The Hicks rule, the Hicks rule 10, when it hits 10 and the supply drops in the momentum portfolio, that's a very good opportunity. Hey, Brian, I think somebody's knocking if you can take it, if it works. So questions, comments, observations about this? Feel free to weigh in.
Couple questions there in the chat, Tim.
Okay. Let's see. And Pam, I have not forgotten. We'll take a look at shot. Thomas, how does the volatility relate to the volatility calculation on the near-term options? That's a very good question. And you might say, well, why wouldn't you use options as a predictor of volatility? And the answer is because the great bulk of options, well over 90% of them, expire without being used. People sell an option to keep the premium, or people buy rights to turn around and sell it, not to use it. So is it a very good indication of volatility? We do not find that to be true. We find our own calculations, by the way, of volatility around earnings to be vastly superior to what the options market indicates. And I think that the answer to that is A, they're not necessarily used, and B, they are heavily leveraged, which distorts. When I say leveraged, if I'm a hedge fund and I buy a big basket of options, they're probably going to be non-standard, not exchange traded. I'm going to go buy them through Goldman Sachs, and then I'm going to borrow 8 to 9 times the money I'm putting to work to lever into them to further, in the hopes that either directionally or in the options market itself, I produce my return. If I'm lucky, it's both. So this differs. This is the underlying asset price movement. And all of those things tie back to the underlying assets. Almost all prices at the bid and the offer, then there'll be everything else in between. 80 to, it's really closer to 90 now. 90% of trades are a derivation of midpoint. In effect, we're putting in midpoint prices. If we say I bought Cisco down 1.7% because its volatility is 1.7%, and I want to make a 1.5% return, I'm effectively buying midpoint. And that's what institutions do. That's all that order flow in the last hour that wants the reference price for indexes and exchange traded funds. And so the prices that change the bid and the offer are set by machines, call it 50% of volume. Then another 20% of the market's volume is indexes and ETFs trying to get between the bid and the offer at derivations of midpoint. There's 70% of volume. Now you add in derivatives, another, call it 18% of order flow. So now where are you? Well, you're close to 90%. The rest is stock picking, which is using different valuation metrics. So all of those price movements really come back to passives and machines. I mean, that's really it. Okay, we know that. We're going to use that to our advantage. Lee, what signals made you choose Google? It was as simple, Lee, as it was in the low volatility portfolio. Number one, there were 2 or 3 times as many stocks in the low volatility portfolio as in the momentum portfolio. That doesn't mean I won't trade momentum. It means I have there was more money interested in low volatility right now than momentum. That's what that math is telling me. 7 in momentum, 30 in low volatility. Ergo, passives want low volatility. And I think it's related to this big tech shakeup. But I just started going down the list, just like I was showing you there. And when I got to Google, I went, wow, that's down 1.7%. I'm buying it. And that's what I did. It was not more complicated than that. Then I set my exit strategy. What's my stop? And if it's already down its full volatility, how much am I willing to risk? Well, I only put it about 30 basis points below that. I thought that mathematically the odds that it moves lower is very low. And that was generally right. So then that with mathematically in the next 24 to 48 hours, there's a very high probability that it rises at least 1.7%. And I was happy to take 1.5. And that's the whole math. Can you expound more on the NASDAQ 100 rebalance? Yes. Okay, GD, 1 week view. Supply has dropped 10% with 5. Bull. It's the one I highlighted it. I forget. On the 12th or 13th, I didn't buy it because it had already moved on me. I didn't have an entry point. But Lee, Martin, I think it's right. Given an opportunity, we would buy that. And what we'll work on mathematically next is what is the mathematical probability of producing a return if you don't buy it down half the volatility? That we know works. It's a high probability. And I don't have the answer. We'll continue to do that math. Yes, I do, Lee. I absolutely put so I buy, what I tend to do is I buy things I buy at the market. If the spread between the bid and the, I'll look at two things. What's the spread between the bid to buy and offer to sell? Bid to buy and offer to sell, sorry. And, if it's a few pennies, and I look at that, and then I look at what's the supply at the top of the book. If there are thousands of shares at the bid and the offer, I'll buy 500 shares. If there are a few hundred, I buy 99 at the market because that by law must be instantly filled at the very best price. And if it's not available in the market, my broker must do it. Okay? Going to have to supply it to me and will have to buy it from me. So I may do that. Boom, boom, boom. Build my position. Then I immediately put my exit strategy in. And Steve Hicks may, or Dan Eisenberg, if you guys want to weigh in with better, sophistication, if you're here, I don't know. Feel free to do that. Or Tim. You guys that have better thoughts on that, feel free. But that's what I do. Become an overbought. I am looking at. Okay, let's look at Mara and let's look at Shop, and then I want to talk about this tech rebalance, and we will have a pretty full session here. Okay, so let's go back here. Let's expand that out. I like to use. I prefer the quick search view because 30 days. That's a 30-day look. So. Everything's constantly changing. So a lot of history is not going to help you produce a better trading return. Money will do, in the space of 1 month, 3 things will occur. There'll be monthly inflows from retirement plans and rejiggers to asset allocations. Are we more or less exposed to equities versus fixed income? Then there are options expirations in the middle of the month. And people will make adjustments to the things they use to true up tracking. Those tend to be derivatives. And then month ends. Hedge funds are going to try to lock gains. Big futures contracts expire. So that gives you a pretty good read on how things are going. Well, it's been awesome, right? When there's the supply moving down and demand never dipping below 5 and very strong. So, what's happening now is it's now over trend. It's done this a few times. So is that enough to cause you to leave? It's a judgment call. I probably would. But I'm extra cautious. I'm really focused on, can I get that return that I'm after? But clearly you can see why it's done so well. Why has this stock performed well? Set aside all the story, whatever, all that stuff. Those are inputs that will all feed into demand. You can look at it and say, well, the reason it's done well is demand's been 5 or better for 30 straight days and supply is falling. Clearly that's good. When those conditions break down, well, it'll change. If this drops and this continues to rise, then the run's really over, and you really want to be out before that occurs if you can. You don't always have to. Depends on your time frame. For short-term trading, I'm looking at 1 to 3 days. For a longer range, you could keep weighting your portfolio toward things that look like this. As soon as this deteriorates, take the money and find something else that's like this. And the dynamic portfolios will help you find that. Okay, then Shopify, let's look at that. So to me, where were the best times to, this is still not it. I don't love, if you were going to do it, it would be right when it hits 10 and supply drops. there's your opportunity, and it dipped that day, but I would have been out in here. Like, I'd take my 2 or 3%. But that's my approach. It continued to have falling supply, but options expired in here, so that will weaken returns, and it didn't give us a whole lot. And Pam, you said, why is demand falling, supplies falling, and prices rising? Well, again, I think that part of there are always little distortions that show up. That tends to be derivatives driven. I would look at that and say, I don't buy falling demand and falling supply. They may cancel each other out. You know, if demand's falling, but so is supply, well, the price could stay level or even, here rise. But I think the rise here is reflective of derivatives. It's probably a bet that Netflix could actually benefit from this big tech shakeup that's coming. And maybe I'll talk about that because I know we don't have a whole lot of time. I've really, there are core things I want to cover, but we're doing great here. So let's talk about this big tech thing that's occurring. I can't remember where I've got that. I think I've got it up out here. I don't see it. Okay, well, I'll tell you. Oh, it's on my laptop. That's what it is. Okay, I can tell you what's occurring. So the trouble is that the 7 largest, in fact, it's even 5 of them are a massive part of the market. They're 47% of the NASDAQ 100. That would be Microsoft is the heaviest weight in the triple Q, NASDAQ 100. Call it 13%. I think Meta is number 2. Might be Apple. One of the two. So Microsoft, Apple, Meta, Nvidia, Tesla. They're like 48% of the market. And if you throw in Google, the voting and non-voting, there's another 7%. And maybe and then Amazon. You throw those together, 55% of an index that's supposed to be 100 stocks. Well, it's so top heavy that anytime people de-weight out of those, it can cause the whole market to tip over, as it did last year. People forget that. It wasn't very long ago and tech totally tipped over. Then it's come back. So what they're trying to do is bring down the weighting of these big 7 down to around 38% from 55%. Well, I don't know if it will make a difference. They remain the most liquid stocks. Is money actually going to adjust, or will they continue to hold those? I don't know. I do think there are two things we could take away from this. One, there are a set of stocks that should benefit. Starbucks could benefit, should get a heavier. These are not my ideas. These are what people are saying. So I think it's really interesting to go look at it and say, well, is it possible? Demand's right at 5 because Starbucks is really a value stock and supply is falling. Possibly. Realize if you do this, it's going to be speculative, but you can go look at the supply-demand balance ahead of this occurrence. By the way, they are announcing tomorrow, Bastille Day in France, what they're going to do, and then they implement it July 24, right after options expirations, and on the day new options are trading on all this stuff. Not when I would have done it, but that's when they're doing it, and maybe they did that on purpose, so that it actually infuses the options market as well. Looking at this, it looks like Mondelez, there's certainly speculation Mondelez is going to benefit. Plunging supply, demand right at 5. Don't worry, price is capricious. Price, it can be, volatile. Let's see, integrated surgical, another one that could benefit from this rejigger. And there are reasons some of these stocks, I would go look at them in a portfolio in particular, because you can look at the dollars per trade and their volatility. Those are very important things for money, the algorithms to get in and out. Can I execute enough trades to move a large position? I'd look at this and say, well, it's not as good, right? It's not the thing I would choose. It doesn't look quite like the others. Gilead, another possibility that could benefit. Again, not bad. It's at 5, and there's been a deficit here in supply. I wouldn't call it as good as the first couple. Let's see, analog devices. I feel like maybe everybody did that already. Here was the opportunity: demand and very level, supply falling. And if you can, you buy a decline, and of course, here's an example of you having several days of it, but it certainly has benefited. Again, not as good as the others. One last one, ADP, and I don't know, but this is what folks are speculating could be the case. It's very handy to be able to look at the supply-demand balance and know that's not bad, right? It's a downtrend in the last 5 days in supply, and then demand being very level could happen. But that's what's occurring. And I point out that, and I don't know what's going to happen. I'm not sure I would want to own. I'm not going to own Google or any of the big five tomorrow because I just don't want to take the risk. I don't know. But in September 2018, the S&P Global created the communication services sector, and it hurt the market. It wasn't the only thing. There are other factors, but the whole market tipped over when everybody tried to rejigger because so much money got shifted into this sector from tech, and so realize that there's risk. I'm not saying that's going to happen, but it's something to keep in mind. Tying this in, and we're getting close to the end here with a look ahead, I'm going to go back to this, just a year-to-date look at the broad market sentiment here. And I think it's in fact, let's go back a year. Because I think it's telling. And I realize everybody's talking about how great the market is, and could we see all-time highs? I find that very unconstructive. Who knows? Things can change. What difference does it make? I mean, if we have a good high probability way to make good returns with low risk, then what difference does it make? Is it going to change it's certainly not going to change what I do. But look at this. If you look at this, here's demand well above the red line. In fact, it did a kind of, whatever you want to call it, double top. It's not a technical term, it's market structure. And supply had plunged. And then they reversed. Demand faltered, supply rose, market fell. Wash, rinse, and repeat. A top. Stocks did great. Supply plunged. Then they reversed. Here, demand soaring, great momentum market, very weak supply. Then it deteriorated, supply rose, demand fell, and the market declined. The weakest of these correlations was here at April options expirations, because we were resetting everything coming out of the banking crisis, which was in March. And so March expirations were affected. We reset. People thought, well, some of the risk is off, and I think that helped the market stay more level, but the principle applied. Strong demand, weak supply, and then they reversed, and the market was flat. And then we just look at this. Plunging supply, very strong demand. Now we're getting top number 2. It's very similar. It's actually weaker than this or this. Now, I don't know if that means anything, but historically, the market has declined after this. If this reverses and demand weakens, then the probability is at best the market moves sideways, and at worst it falls. Again, I don't know what's going to happen, but I certainly look at that and affects my I'd rather, the data is pretty compelling. The historical data is pretty compelling. So I put way more stock in this than I do what somebody says might be ahead, because this reflects all motivations, not just one. Again, it's not perfect, but it's worth keeping in mind. Last thing I have for you, little anecdote. So, I will go back to I share things that work beautifufully. Goog and Lamb Weston. I bought ALL with some of those proceeds, redeployed it yesterday down, a little bit. It was, I bought it, I don't know, 107.10, something like that. And so it finished the day at 107.60. I felt really good about that. You look at the supply demand equation, and it looks good. And then right before, like an hour before the market opened, all of a sudden it was down to 104. And my stop is well above that. Now, the market is algorithmic. We say 98% algorithmic. It's probably very near 100%. So when the market opened, that algorithm from Interactive Brokers kicked in and exited me at 104.10. So I lost a chunk of money. And what do you do about that? There was no explanation. Certainly, it doesn't report results till August. There's sometimes that happens. And so what did I do? Bought it again, right? It was way down. I'm just gonna, that's what I'm gonna do. And I had to reset things. I don't know how it'll go today or tomorrow. Maybe I've recovered a lot of what had gone away, and my other positions did fine. So it was still a good day for me today. But what do you do in those circumstances? Well, I mean, I thought that was as good as anything. I look at why would I not? It just gave me a better entry point, and it makes the point. It doesn't matter what the price is. All that matters are percentages and probabilities. If I had a good probability at 107 of producing a return, I have a much better probability at 104, all other things being equal. So why wouldn't I repeat it? Again, it doesn't always work out. Maybe there's some cause for that other than market structure, but I don't believe so. Anyway, that's okay. That's what I've got. I want to make sure we've answered questions. Steve, there you are. Good to see you. Let's see. Okay, thank you, Brian. Okay. Did I cover? I think I got everything, right? Did I get it pretty close? Okay. Any final comments, observations, words of wisdom? Steve Hicks, do you want to opine with some words of wisdom? No? I opine with words. I keep not words of wisdom. Okay, well then, very good. We'll barring the unforeseen, I'll have this demo replay for you tomorrow in tomorrow's market desk note. Good to see you. We'll do it again next week. See where we are. We'll be in the middle of options expirations. It'll be just kicking off earnings season. Context creates risk. Don't buy anything without checking whether they're reporting, because you can get caught out. And make sure you got because the stuff moves outside market hours. That's the trouble. Okay, good to see you.